सो हेलो एवरीवन। वापस से स्वागत है आप लोग का हमारे सेशन में। देख सकते हैं गोल्ड का मूव 1861-62 के आसपास मूव करते हुए देखने को मिल रहा है। मोर ओवर हम लोग तो डिस्कस करेंगे अपने न्यूज़ एनालिसिस के बारे में। सो डिस्कस करने से पहले एक बार क्लियर कर दीजिए, आप लोग को आवाज़ क्लियर आ रही है, स्क्रीन प्रॉपरली विजिबल है? इफ यस काइंडली प्रेस 40 so that we can continue our session from here. ओके, सो हम लोग अपनी चीज़ें डिस्कस करते हैं and we are moving towards the fundamental overview. So gold attracted fresh buying on Thursday and climbed to 1865 region during the mid-European session. Albeit lacked any follow-through, the intraday uptick stalled just ahead of a 5-month stop, touched in reaction to hotter than expected US consumers inflation figures on Wednesday. In fact, the headlines US CPI rose at the fastest annual pace since 1990 and fueled buying interest rate in precious metals, which is proven long-term hedge against rising prices. However, rising betas are for a more aggressive Fed policy response to contain stubbornly high inflation might cap gains for the non-yielding yellow metal. In fact, the Fed funds futures market indicate that the first rate hike could come as soon as July 2022. This was reinforced by overnight massive rally in the US Treasury bond yields. This, along with the stronger US dollar, acted as a headwind for dollar denominated commodities, including gold. So, meanwhile, the downside remains cushioned amid the prevalent cautious mood around the equity markets, which tends to benefit the safe haven gold. Nevertheless, the precious metal so far has managed to hold in the positive territory for the sixth successive day. That said, bulls might refrain from placing aggressive bets, rather prefer to wait for a fresh catalyst amid a relatively thin liquidity on the back of a bank holiday in the US. Even from a technical perspective, RSI 14 on the daily chart has just moved above 70, indicating a slight overbought condition. This further warrants some caution before positioning for any further appreciating move for gold prices, at least for the time being. 1 week average forecasting declared to 1798, bias is bullish. For 1 month it is 1805, and for 1 quarter it is 1834. It would be changed क्योंकि प्राइसेस बहुत ही तेजी से ऊपर निकल चुके हैं. Gold weekly forecast XAU USD turns bullish. So gold weekly forecast XAU USD turns bullish on falling bond USD. Its technical breakout. So gold has fluctuated in a wide range. So gold has fluctuated in a wide range throughout the week. So gold has fluctuated in a wide range throughout the week, following US Treasury bond yields, supported XUUSD in face of broad USD strength. Investors will keep a close eye on yields amid a lack of high-tier data releases. So gold struggled to find direction in the first half of the week, but came under strong bearish pressure late Wednesday with the initial market reaction. So gold struggled to find in the first half of the week, but came under strong bearish pressure late Wednesday with the initial market reaction to the US Federal Reserve policy announcement. The sharp decline witnessed at the benchmark 10-year US Treasury bond yield, however, allowed XAU-USD to take a decisive rebound up towards 1800 on Thursday. Although the dollar ended the week decisively higher against other major currencies, gold didn't have a difficult clinging to its gain in the second half of the week. So the data from the US revealed on Monday that ISM manufacturing PMI edged lower to 60.8 in October from 61.1 in September. The prices paid component of ISM survey jumped to 85.7 from 81.2, confirming that input price pressures remained elevated. Nonetheless, XAU USD stayed in consolidation phase with the investor moving to the sidelines ahead of Fed's policy decision. So, as expected, the Fed left its benchmark interest rate, the target range for federal funds, unchanged at 0 to 0.25% and unveiled that it will start reducing asset purchases by $15 billion per month starting mid November. During the press conference, FOMC Chairman Jerome Powell reiterated that they will not automatically hike the policy rate once the quantitative easing program concludes. The chairman further emphasized that they see higher inflation persisting and said that they will be ready to address that risk. Although the immediate market reaction caused the greenback to weaken modestly against its major rivals, XAU-USD turned south with the 10-year US Treasury bond yield shooting higher. On Thursday, the dollar regarded its strength and As it currently stands, the positive correlation between the dollar's market valuation and yields seem to have weakened. More importantly, yields are having a more significant impact on XAUSD than the dollar's relative performance against other major currencies. Meanwhile, the Bank of England's decision to leave its policy rate unchanged at 0.1% was another factor that weighed on global yields on Thursday. On Friday, the US Bureau of Labor Statistics reported that non-farm payrolls rose by 531,000 in October, surpassing analysts' estimate of 425,000. The dollar preserved its bullish bias after this data, but gold stayed resilient with the 10-year bond yield breaking below 1.5% on Friday. Next week की बात करें, so there won't be any high tier macroeconomic data releases at the start of the week, and investors will keep a close eye on US Treasury bond yields. Currently, the 10-year is below 1.5%. Currently, the 10-year yield is below 1.5%, and unless it's managed to rebound above that level, XAUSD could continue to push higher. On the other hand, gold could lose interest in the case that the 10-year yields reclaim 1.6% and steadies above that level. On Wednesday, the US Bureau of Labor Statistics will release the October Consumer Price Index data, the core CPI, which excludes volatile food and energy prices. On Thursday, the UK's Office for National Statistics will publish the third quarter gross domestic product, that is GDP data, following the BOE's last policy decision. The CME Group BOE Watch On Thursday, the UK's Office for National Statistics will publish the third quarter GDP data. Following the BOE's latest policy decisions, the CME Group BOE Watch tool shows there is a 67.5% chance of a 15 basis point rate hike in December. In case the GDP report shows a significant slowdown in the UK's economic activity, the odds of a December hike could decline and weigh on global yields. The University of Michigan's preliminary November Consumer Sentiment Index will be featured in the US Economic Decade on Friday. So, gold technical outlook, gold close above the 200 days and 100 days simple moving averages for the second straight day on Friday. Additionally, the relative strength index on the upside, XAU could target 1810 ahead of 1820. A daily close above that level could open the door for additional gains toward 1835. So first support now aligns at 1790 and before 1785. आ जाते हैं MT4 टर्मिनल पे तो MT4 टर्मिनल पे गोल्ड के प्राइस वापस से कंसोलिडेशन के फेज में 1761 के लेवल्स पे सो हम लोग आते हैं अपने गोल्ड न्यूज़ रिटर्न्स पे, बट उसके पहले हम लोग कुछ डिस्कशन पॉइंट देख लेते हैं। सो हम लोग डिस्कस कर रहे हैं कुछ पॉइंट्स आज के लिए।
We're here now with Tim Grisky. He is a senior portfolio strategist at Ingalls and Snyder, and we'll be discussing today his macro outlook and how to allocate your assets. Tim, welcome to Kitco. It's your first time. Pleasure to have you on the show.
Thanks, David. Thanks for having me.
My pleasure. Let's start with today's CPI reading. It's the big news of the day. 6.2% is the largest or the highest inflation reading since the early 90s, 1990 to be exact. And so what we've seen is inflation not being transitory, at least not for now. It's been sticky for a number of months now. What's your outlook? Do you think 6.2 is the highest we can get?
It looks like it may stabilize at this area. That's a high level of inflation, though. If it keeps reoccurring, that's the thing about inflation. It has to keep reoccurring. So it's not just prices up 6% this year, but will it be up 6% again next year? We have a hard time coming to that conclusion, and the Fed does as well. We really think that this is a temporary spike of inflation caused by a number of factors, but chief among them is the semiconductor sector, which has been starved for product. And there is a huge effort out there to produce semiconductors. That I think is going to, in time, work off not only the semiconductor inflation and lack of supply, but overall inflation as well. We really think we're going to come back down to a lower level of inflation. The Fed is targeting 2% as structural inflation. That was very hard to get there before the pandemic. That we're really in a deflationary economy globally. Thanks to companies like Amazon, for instance, that really have brought down the prices of so many goods, and their services as well from other companies that have been brought down. We really think that in this inflation spike is temporary. It's concerning. The bond market is certainly concerned about it, and you see yields jumping up today. Because of the CPI numbers and the PPI numbers yesterday as well.
Okay, let's walk through some of the components of the CPI. So if you take a look at the breakdown here, the biggest movers seem to be energy again and used cars. So going back to your statement about inflation being sort of a passing spike, which of these components do you see persisting in terms of its growth, in terms of price, and which of these components do you think will stabilize first?
Well, I think you have to look at them. The energy sector is so difficult to predict, and we certainly have a bit of a supply shortage or supply bottleneck actually in energy. That should be worked off over time. You certainly also at the same time have a huge interest and purchasing of electric vehicles and use of solar panels that should also be a deterrent to higher energy prices. But supply is very key here, and the big producers, OPEC Plus, have been very stingy about supply. There may be a point here where they do come back in and increase supply and bring those back down. And we see energy sector today is actually the weakest performing sector in the markets. I think because of that, because of the run up that this sector has had, and because the probability is those prices are going to come back down. If you look at some of the other big inflationary items in that CPI, used cars and new cars, and those are really one market. I just bought a used car, actually, a couple of years old, and got what I thought was actually a pretty not a terrible price at all. But it comes back to the chips. Semiconductors are used throughout cars, and there just simply isn't supply. Where I bought the car, their lot was largely empty. They just can't get the supply of new cars. And of course, lack of supply, steady or increased demand, you're going to see inflation.
That's a very good point. Now, Tim, I wonder what the Fed is going to do now. I know they look at PCE and not actual CPI, but even if you strip out the core components, so if you strip out energy and food, core CPI is still at 4.6%. That's the highest since '91, and which is double, by the way, the Fed's 2% average inflation target. What are they going to do next?
Well, the Fed doesn't usually know what they're going to do next. And I think that's why we all sit around and talk about what the Fed might do or is going to do and try to read into every word of every meeting of the Fed. But the Fed is very clear that conditions change and things may change for them. We certainly take them at their word that they're going to start tapering before year end, and we're sure getting close to year end here. So we're going to see fewer bond purchases, or at least no increase in bond purchases for a while. But this extraordinary measure, this tapering, this buying of bonds in the market by the Fed, should roll off here. We're not in a desperate situation with the pandemic. So we think, we take the Fed at their word that probably in 6 months or so, the tapering will be gone.
Now, you said earlier that we are still in a deflationary economy worldwide. What do you mean by that?
Well, you look at all of what technology does in terms of decreasing the cost of goods, the price of goods to consumers, even the transportation of goods, which has been a bottleneck, certainly. But all these things have come down, and they will likely continue to come down. A big story recently has been self-driving trucks and how that's going to be the next big wave here, probably before self-driving cars, and it probably makes a lot of sense. That's going to reduce the cost of transportation. It comes with social issues. What happens to all those truck drivers? Although the last mile is probably still going to be driven by somebody. But on a highway, having self-driving trucks, I think, makes a lot of sense. It's going to save fuel and it's going to save costs, obviously. And it's deflationary. There are lots of deflationary factors out there and companies that specialize in it.
So I think, from what I understand, Tim, what you're saying is technological innovation is going to make our living or cost of living cheaper, or at least more affordable down the line.
Yes,
But
exactly.
I guess it's a matter of which wins first, right? In terms of which is a stronger force, that technological innovation or the increase in the money supply that's driving up asset prices right now. What do you
Right.
think is going to win out at the end?
Well, I really think that technology wins out. We're in this, continue to be in this technological revolution. I think it's greater than the industrial revolution from over a century ago, and the innovation continues, and we're going to just continue to see costs come out of companies and companies being run more efficiently. You look at what ServiceNow does in terms of making everything more efficient within the workplace and the communication, the flow of information. It's really, I think that technological deflationary factor is huge and going to continue.
Okay, well, I know you're not a tech fund per se, but let's talk about tech disruptors because that's important for any investor. For example, back in the 90s, I don't think you would have been long Kodak for very long. That would have been a bad play. So understanding technological trends is still very important. What do you see as some of the major forces of change happening in the next 5 to 10 years that you should be paying attention to as an investor?
Well, I think it is that, what we always look for in terms of investing is change. Companies that are either changing themselves or they're changing the world. And there's so many of them out there. All these companies involved in the cloud, whether it's Amazon with AWS or Microsoft, or many of the others in some way are involved in the cloud. That is such a streamlining of how we reach technology, where we store it, how quickly we can get it, and how protected it is. That type of innovation we think is just going to continue, and the growth there is huge. You can also play it with REITs, the REITs that own the real estate, where all these the tech servers are. Great companies doing that as well. So that's an area where we've focused quite a bit. It's also in those companies that are creating efficiency within the workplace. ServiceNow is a great example of that. Salesforce.com, another example of that. There are many of those examples.
Okay. EVs, electric vehicles, is a major theme that's making headlines everywhere. Just of course, we were just talking offline. Rivian made its IPO, $91 billion. It's I'm reading the headline from CNBC.
Yeah.
I don't know if they're making this tongue in cheek, but the Rivian IPO proves General Motors is undervalued, says GM CEO Mary Barra. I don't know what that's supposed to mean. Do you think GM is undervalued by comparison?
Or do I think Rivian is overvalued? There aren't a lot of exciting IPOs like we used to have back in the late 90s, where you had all that, the IPO boom in technology.
Yeah.
So we have one today, and I'm not surprised to see it up a huge amount. It came above the indicated price as well. There's a lot of excitement about it. Does the valuation make any sense? I have a tough time believing that, but this isn't a market that focuses a lot on valuation. Valuations aren't totally out of control, but I'd say there isn't a lot of focus on valuations right now. So, this stock is off to the races. They've got a great product. They're a first mover. They've had some production problems, but we think they're going to be a force here. Certainly, Chevy and Ford and Toyota and with all their huge exposure in trucks aren't going to be left behind. But they're playing catch up at this point. And if Rivian can keep innovating, just like Tesla has continued to innovate, they're going to get a good, decent market share of the truck market, we think. It'll be exciting to see what happens.
Yeah, but just for context sake, GM is currently valued at $86 billion for its market cap.
Yeah.
And as I mentioned at one point, the Rivian IPO reached $91 billion based on the price that the shares were trading at. So we've got a new company, a startup brand that's trading at a higher premium valuation than a company that's been around for 100 years.
Unbelievable. And that has huge sales. And Rivian just sold their first truck last month. I think it was. Yeah, last month. And so
What's interesting to me is that all these other brands, GM, Ford, even the European automakers, are switching into EVs. Why aren't we seeing their valuations tick up?
Well, why aren't we
Yeah,
seeing them? We do see. Volvo is going to come public again, so I do think that their valuations are ticking up somewhat. A company like Rivian is, and I'll say this about Tesla too. It's a cult stock,
I see.
and it's stocks that really can't be bought on valuation. It's bought on a concept, and a concept that this new look, new type of company is going to eventually dominate the markets. We have a tough time coming to that conclusion because there are a lot of car companies out there, a lot of truck companies that aren't going to sit still, and they're going to be able to drive prices down and sell a very good product eventually. I don't think they're quite there yet. But some of these companies are really beginning to produce good new products. Volvo and their fleet now of electric vehicles and hybrid vehicles, they're going to go all electric over the next several years.
That's right.
Great company.
So the idea of investing in a company that's hyped, or a company like GME, GameStop, AMC, these meme stocks that we've seen earlier in the year from the Reddit boom. This phenomenon of hype investing, is that something that you've witnessed before in your career, or is this completely new?
Sure. The whole GameStop issue with Robinhood and all that, we've seen that play out a lot in the past, and it's simply known as a short squeeze. You look for a stock that is very heavily shorted. You begin buying it like crazy, and that forces the stock price up. It forces the shorts to cover their shorts, and that forces the stock price up even more. So we've seen this before. It's somewhat gaming the markets, and if you can make money out doing that, if you can get in at the right time, get out at the right time, all power to you. I wouldn't call this. I don't label it investing. It's much more of a speculation or gaming the markets. But people make money, and you just don't want to be the last one out in these situations.
Sure. It's just social media has made it easier to do these short squeezes because the spread of information is more accessible to everybody now, all retail investors and institutional investors alike. Whereas back in the 90s, perhaps it wasn't as easy to access such information. Let's say, does this social media phenomenon change the way you might invest?
Well, certainly pay attention to it. I'm a voracious reader of everything, whether it's traditional media, social media. I listen to everybody and everything I can get my hands on.
Yeah.
But in terms of how I invest for clients, it's with a bit of a longer term perspective. We pay attention to taxes, for instance, and we're not big traders. We don't tend to trade around positions. We find companies we think we can own forever, and that means the company is getting better. It tends to do very well, and then another idea comes along, or something happens to that company, and we move on. But we love finding great companies to invest in that we think are selling it not an outrageous valuation, a valuation that they can grow into in a pretty reasonable period of time.
Can you give us one example of a company that you can hold on to forever, in your words?
Well, anything in our portfolio right now, we think we could hold on to forever. I think that never actually will happen, probably.
Okay.
But you look at the dominance of a company like Microsoft,
Okay.
Where they own Windows and therefore they really own PCs. Google is so embedded, into everything we do on the internet. It's hard to see how some of these companies are going to be displaced, but I've got no question. There's no question in my mind that we're great innovators, not only in this country but globally, and we're going to come up with new ways of doing things that are going to be exciting and are going to supplant, some of these companies eventually,
That's right.
or make them less powerful.
Let's put all this together now. You're viewing the global economy as one of being in a deflationary environment, and you're long on some of these tech companies that you mentioned. Where should investors be allocating their capital in terms of some of the sectors that you might recommend, or maybe just asset classes in general?
Sure. Well, again, we've been very concentrated in our portfolio, not only in terms of number of securities, equity securities, but also in sectors. If you look at our portfolio right now, you'd say it's a very techie portfolio. And I was trained as a value manager, so that's a big statement for me. I think you have to look in the technology sector, and you look for the innovators. You look for those companies gaining market share and entering new markets. And you look for the innovators. So companies like Amazon, Microsoft, Google, Adobe, ServiceNow. It's a long list, I think, of very strong companies. We do venture outside of that. We want some industrial exposure coming out of the pandemic. We have exposure to companies like Boeing, which are, again, a global duopoly. So very dominant, and it's a growth market. There's going to be an increasing demand for airplanes, and also for eventually for more fuel efficient airplanes, as well. And companies like Train Technologies, which is the HVAC company, and again, filters on air circulation systems, warming environment. Increased need for air conditioning. These are strong and very globally dominant companies.
How do you feel about commodities?
Well, I was a metals analyst when I first came into this business. So I have a sweet spot for metals. Certainly, commodities is much bigger than just metals. It's a tough sector to value. Prices move all over the place, and often for unknown reasons or very speculative reasons. They tend to be trading stocks, I think, but they're people that are very good at it. But I think you can make money in metals on a bit of a longer term basis. I think it's much tougher in things like ag and things like gold, silver, and I'd throw crypto in there as well. Not tough to make money in crypto right now, but at some point, and we've seen it, already in crypto's short life, those prices will come down and come down sharply. So, it's great to be in it right now when it's going up, but you want to make sure you're also out of it quickly when it begins going down.
I'm just curious, given your inflation and deflation outlook, where you see gold fit into your macro picture.
Gold is sort of, and crypto really is too, but gold is the anti-investing. One of my mentors in this business, Ken Hebner, used to call it anti-investing, and I think it's sorry about that. It's a fear investment. When you think everything is going to fall apart, it's when you put money into gold. There are people that hold it forever. I have a hard time believing that that's really a good thing, because if we're in Armageddon and you take your hunk of bar of gold out to a farm and say, I'd like to give you this for a bunch of your crops, I'm not sure farmers would really make that trade. But it does give a level of security to a number of people. I think that's great. If it makes you comfortable, do it. But it costs money to store it. It costs money to trade it, and that cost tends to be high. So it doesn't pay dividends. It just is it's a speculation on price.
I see. All right. Well, Tim, fantastic thoughts. Thank you for joining Kitco, and I look forward to following up with you next time.
Thanks, David.
Thank you for watching Kitco News. Don't forget to tune in next Wednesday on
shorted, you begin buying it like crazy, and that forces the stock price up. It forces the shorts to cover their shorts, and that forces the stock price up even more. So we've seen this before. It's somewhat gaming the markets, and if you can make money out doing that, if you can get in at the right time, get out at the right time, all power to you. I wouldn't call this. I don't label it investing. It's much more of a speculation or gaming the markets. But people make money, and you just don't want to be the last one out in these situations.
Sure. It's just social media has made it easier to do these short squeezes because the spread of information is more accessible to everybody now, all retail investors and institutional investors alike. Whereas back in the 90s, perhaps it wasn't as easy to access such information. Let's say, does this social media phenomenon change the way you might invest?
Well, certainly pay attention to it. I'm a voracious reader of everything, whether it's traditional media, social media. I listen to everybody and everything I can get my hands on.
Yeah.
But in terms of how I invest for clients, it's with a bit of a longer term perspective. We pay attention to taxes, for instance. And we're not big traders. We don't tend to trade around positions. We find companies we think we can own forever, and that means the company is getting better. It tends to do very well, and then another idea comes along, or something happens to that company, and we move on. But we love finding great companies to invest in that we think are selling it not an outrageous valuation, a valuation that they can grow into in a pretty reasonable period of time.
Can you give us one example of a company that you can hold on to forever, in your words?
Well, anything in our portfolio right now, we think we could hold on to forever. I think that never actually will happen, probably.
Okay.
But you look
So you have